This presentation is for Chapter 9, Responsibility Accounting and Performance Evaluation. In Learning Objective 4, we will use return on investment and residual income to evaluate investment centers. Investment centers are typically large divisions of a company. The duties of an investment center manager are similar to those of a CEO. The CEO is responsible for maximizing income in relation to the company's invested capital by using company assets efficiently. Likewise, investment center managers are responsible for not only generating profit, but also making the best use of the investment center's assets. The financial evaluation of investment centers must measure two factors. One, how much operating income the segment is generating, and two, how efficiently the segment is using its assets. Based on operating income alone, the tablet computer division with operating income of $975,800 appears to be more profitable than the e-learning division with operating income of only $450,000. However, this comparison is misleading because it does not consider the assets invested in each division. The tablet computer division has more assets than does the e-learning division. To adequately evaluate an investment center's financial performance, companies need summary performance measures or KPIs that include both the division's operating income and its assets. Return on investment is one of the most commonly used KPIs for evaluating an investment center's financial performance. ROI is a measure of profitability and efficiency. Companies typically define ROI as follows: operating income divided by average total assets. ROI measures the amount of operating income an investment center earns relative to the amount of its average total assets. Although the tablet computer division has a higher operating income than the e-learning division, the tablet computer division is actually less profitable than the e-learning division when we consider that the tablet computer division does not utilize its average total assets as efficiently. To determine what is driving a division's ROI, management often restates the ROI equation in its expanded form. Notice that net sales revenue is incorporated in the denominator of the first term and in the numerator of the second term. When the two terms are multiplied together, net sales revenue cancels out, leaving the original ROI formula. In this expanded form, return on investment equals the profit margin ratio times the asset turnover ratio. The expanded form of return on investment reveals that profitability and the efficiency of asset usage are driving the ratio. The profit margin ratio is a profitability measure that shows how much operating income is earned on every dollar of net sales. So profit margin ratio is equal to operating income divided by net sales. To increase the profit margin ratio, management must increase the operating income earned on every dollar of sales. Management may cut product costs or selling and administrative costs, but it needs to be careful when trimming costs. Cutting costs in the short term can hurt long-term ROI. The e-learning division has a profit margin ratio of 6%, meaning that it earns operating income of 6 cents on every $1 of sales. The tablet computer division, however, is much more profitable with a profit margin ratio of 19%, earning 19 cents on every $1 of sales. The asset turnover ratio measures how efficiently a business uses its average total assets to generate sales. Asset turnover ratio is equal to net sales divided by average total assets. If managers are not satisfied with their division's asset turnover ratio rate, how can they improve it? They might try to eliminate non-productive assets, such as by being more aggressive in collecting accounts receivable, decreasing inventory levels, or disposing of unnecessary plant assets. The e-learning division has an asset turnover ratio of 3. This means that the e-learning division generates $3 of sales with every $1 of average total assets. The tablet computer division's asset turnover ratio is only 81 cents, or 0.81. The tablet computer division generates only 81 cents of sales with every $1 of average total assets. The e-learning division uses its average total assets much more efficiently in generating sales than the tablet computer division. As you can see, the expanded ROI equation gives management more insight into the division's ROI. Management can now see that the tablet computer division is more profitable on its sales, with the profit margin ratio of 19%, than the e-learning division is with a profit margin ratio of 6%. But the e-learning division is doing a better job of generating sales with its average total assets, with an average asset turnover ratio of 3, than the tablet computer division with an asset turnover ratio of 0.81. Therefore, the e-learning division has a higher ROI of 18%. ROI has one major drawback. Evaluating division managers solely on ROI gives them an incentive to adopt only projects that will maintain or increase their current ROI. For example, if top management has set a company-wide target ROI of 16%, that means they would want e-learning division to invest in equipment that has an ROI of 17%. However, the e-learning division currently has an ROI of 18%. If the e-learning division invests in the equipment, its overall ROI will decrease. Therefore, the manager of the e-learning division will probably turn down the investment. Residual income is another commonly used KPI for evaluating an investment center's financial performance. Similar to ROI, residual income considers both the division's operating income and its average total assets. Residual income considers both the division's profitability and the efficiency with which the division uses its average total assets. So residual income incorporates another piece of information: top management's target rate, such as the 16% target rate of return that we talked about in the previous slide. The target rate of return is the minimum acceptable rate of return that top management expects the division to earn with its average total assets. So residual income is a measure of profitability and efficiency computed as actual operating income less a specified minimum acceptable operating income. Residual income compares the division's actual operating income with the minimum operating income expected by top management given the size of the division's average total assets. Residual income is the extra operating income above the minimum operating income. A positive residual income means that the division's operating income exceeds management's target rate of return. A negative residual income means the division is not meeting the target rate of return. The positive residual income indicates that the e-learning division exceeded top management's 16% target rate of return expectations. The residual income calculation also confirms what we learned about the e-learning division's ROI. Recall that the e-learning division's ROI was 18%, which is higher than the target rate of return of 16%. The tablet computer division's ROI is negative. This means that the tablet computer division did not use its average total assets as effectively as top management expected. Recall that the tablet computer division's ROI of 15% fell short of the target rate of return of 16%. A company may prefer to use RI over ROI for performance evaluation because RI is more likely than ROI to lead to goal congruence. This is because each project is evaluated on whether it yields a positive or negative residual income, not on whether it will increase or decrease a division's residual income, as was the case with ROI. This exhibit summarizes the KPIs for investment centers. A company may prefer to use RI over ROI for performance evaluation because RI is more likely than ROI to lead to goal congruence. Recall that total assets is a balance sheet amount, which means that it is a snapshot at any given point in time. Because the total assets amount will be different at the beginning of the period and at the end of the period, most companies choose to use a simple average of the two amounts in their ROI and RI calculations. Not all assets used in ROI and RI or as non-productive assets may skew the ROI and RI results. One serious drawback of financial performance measures is their short-term focus. Companies usually prepare responsibility reports and calculate ROI and RI figures over a one-year time frame or less. If upper management uses a short-term time frame, division managers may have an incentive to take action that will lead to an immediate increase in these measures, even if such actions may not be in the company's long-term interest. And that is the conclusion of the presentation for Learning Objective 4.